Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Optimizing Investments with Monte Carlo Simulation, a practical guide. Limitations and challenges of Monte Carlo Simulation. Monte Carlo Simulation is a robust tool for assessing risk and making informed investment choices, but it's not without its flaws. When used in the wrong way, it can lead to more confusion rather than clarity. Let's dive into some of the common pitfalls and hurdles that investors face when using this complex method. Data quality. The accuracy of Monte Carlo simulations is heavily reliant on the quality of the data fed into them. Ever heard the saying, garbage in, garbage out? That's precisely the case here. If your input data is flawed, expect the output to be just as unreliable. Accuracy is key. High quality and up-to-date data drive meaningful results. If you're using outdated or skewed information, the projections generated will hardly reflect reality. Financial data is volatile, and small inconsistencies can have a big impact. Sources matter. Different data sources can yield varying outcomes. It's essential to cross-verify data, ensuring it comes from credible and consistent sources. Anomalies or biases in historical data can lead to projections that are off the mark. Complexity of models. While a robust model can offer deep insights, there's a thin line between complexity and chaos. Overly complicated models often end up being more of a hindrance than a help. Simplicity triumphs. Adding layers of complexity can make a model difficult to manage and understand, leading to inaccurate interpretations. Imagine trying to solve a labyrinth. Sometimes the simplest paths yield the best outcomes. Misleading results. More variables don't always mean more accuracy. Complicated models, while enticing for their depth, can result in misleading conclusions if not managed properly. Investors might find themselves relying on distorted results, making decisions that don't align with actual market behavior. In essence, while Monte Carlo simulation is a powerful ally, its effectiveness hinges on precise data and clear, well-structured models. By being aware of these limitations, you can better harness its potential for your investing strategies. Best practices for using Monte Carlo simulation in investing. Harnessing the power of Monte Carlo simulation can transform your investment strategy, but it requires a mindful approach. The key lies in selecting the right inputs and performing diligent sensitivity analysis. Here's how you can effectively apply these practices. Choosing the right inputs. Your simulation is only as good as the inputs you choose. Picking suitable variables and distributions is pivotal to building a reliable model. Consider it like crafting a recipe. Each ingredient plays a crucial role in determining the dish's final taste. Misstep here, and your results could be skewed. Identify relevant variables. Focus on factors that genuinely impact your investment strategy, like interest rates, inflation, and market volatility. Irrelevant data will only muddy the waters. Select appropriate distributions. Choose probability distributions that accurately reflect the market conditions you are modeling. For example, a normal distribution might suit stock returns, capturing both the typical and the extreme. Constant updating. Markets evolve. Regularly update your inputs to reflect the latest market data. Keeping your model current ensures that your predictions remain relevant and actionable. Sensitivity analysis. Imagine trying to balance a seesaw. Even a slight shift can tip the balance. Sensitivity analysis in Monte Carlo simulation serves a similar purpose, helping you understand how changes in inputs affect your outcomes. It's a vital check to ensure your model's robustness. Measure impact. Determine which variables significantly influence your results. Are you focusing too heavily on minor factors? This analysis helps spotlight the main drivers of your investment strategy. Scenario testing. Test various assumptions and conditions to see how they affect your model. Would a slight increase in inflation derail your plan? Checking these scenarios can prepare you for unforeseen changes. Avoid overconfidence. While simulations provide a range of outcomes, they aren't foolproof. Acknowledge the limits of your model and remain open to tweaking your variables as you gather more data. Using Monte Carlo simulation effectively demands a thoughtful balance between input selection and validation through sensitivity analysis. Employ these best practices, and you'll navigate the investment seas with greater clarity and insight. Future trends in Monte Carlo simulation for investing. Monte Carlo simulations in investing are evolving, with new trends on the horizon set to redefine how we assess risk and strategy. The main forces driving these changes include integration with machine learning and the ever-increasing power of computation. These advancements promise to take simulations to new heights, offering investors richer insights and more precise predictions. Integration with machine learning. The fusion of Monte Carlo simulations with machine learning holds enormous potential. Think of it as bringing together two sharp minds to solve a complex puzzle. Machine learning can process vast amounts of data swiftly, identifying patterns and anomalies that might be missed with traditional methods. Enhancing predictions. By feeding machine learning algorithms the results from countless Monte Carlo simulations, we can refine predictions with greater accuracy. Machine learning models can adjust on the fly, learning from new data patterns and improving forecasting over time. Adaptive models. Imagine a GPS that recalculates the best route based on real-time traffic conditions. Similarly, machine learning can adapt simulation models to account for market shifts. This dynamic adjustment helps investors make well-informed decisions even when market conditions change abruptly. Data-driven insights. Machine learning thrives on data. Integrating it with Monte Carlo simulations enables investors to uncover hidden correlations and investment insights that enhance decision-making processes. The synergy between these technologies can lead to strategies that are not just reactive but anticipatory. Increasing computational power. With technology steadily advancing, the raw power at our disposal is unlocking potentials we once only dreamed of. As computational capabilities expand, so does the ceiling for what Monte Carlo simulations can achieve. Greater detail and depth. Enhanced computational power means simulations can process more variables over a higher number of iterations. Imagine analyzing every grain of sand on a beach. More power allows for more granular analysis, capturing the nuances that lead to smarter investment strategies. Speed and efficiency. Faster processing means getting results quicker. In a fast-moving market, this speed can translate into timely and actionable insights. For investors, the difference between success and failure can come down to who acts first. Complex models made realizable. Models that once seemed too complex to run effectively are now becoming feasible. With increased power, simulations can explore intricate scenarios involving multiple factors, providing a more comprehensive view of potential outcomes. Together, these advancements point towards a future where Monte Carlo simulations are more powerful, precise, and integral to investing than ever before. By embracing these trends, investors can stay ahead of the curve, ensuring their strategies are robust and competitive in an ever-evolving market. Conclusion. Monte Carlo simulations are a game-changer in investment strategy. They take randomness and turn it into a tool for insight, letting you see potential risks and rewards with clarity. By simulating countless scenarios, these models reveal the spectrum of possible outcomes, helping you prepare for both sunny days and stormy markets. Armed with this knowledge, you're not just reacting to market changes, you're planning for them. So, dive into the data, embrace the uncertainty, and let Monte Carlo simulations be your guide. Ready to sharpen your investment skills? Start applying these methods today and see the difference they can make in your strategy. Are there any other tools you'd pair with Monte Carlo simulations? Share your thoughts and let's keep the conversation going. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.